Fee-based banking services. Banks earn their income in two parts. One type of income is generated by undertaking risks, by lending their deposits. This is called interest income and forms the major portion of any bank's earnings. However, banks can also generate earnings from other sources wherein they do not have to lend money or collect interest. Such sources are called fee-based banking services and form an important part of any bank's profit and loss statement. So, we will list down the various sources from which banks can generate non-interest, fee-based income. Cards. Credit cards and debit cards have been new additions to the bank's portfolios. However, in a short span of time, these services can start accounting for large sums in any bank's non-interest earnings. There are a variety of fees charged by these cards. There are some fees like joining fees and annual fees. Then there are charges such as interest on overdue balance, over-limit fees, service tax, etc. All these charges were not a part of any bank's earnings a few years earlier. Besides, every time a credit or debit card is used, banks that have issued such cards are paid fees by the merchant. The introduction of credit cards has created this new addition to the bottom line of the bank's income statement. Commissions. Banks have also started providing other services like selling insurance and mutual funds to their customers. Since banks have an intimate relationship with the customer, they are in a position to estimate their net worth and advise them regarding insurance as well as investment needs accordingly. Hence, insurance companies and mutual fund companies collaborate with banks to provide a one-stop shop to the customers. Banks charge commissions to market these services to their customers. Over a period of time, commissions from bank assurance have started accounting for a significant percentage of non-interest incomes. Capital market advisory. Banks often assist corporations in their debt issues in the bond market. They understand the macroeconomic condition very well, given their vast experience with capital markets. Hence, they can advise corporations regarding the quantum of debt to be issued, the interest rate at which it needs to be issued, as well as the time when issuing such debt would make selling it easier. Banks usually do not underwrite these debt issues. Instead, they simply charge a flat fee for the advice that they provide and the expertise that they bring to the table. Demand drafts and pay orders. Demand drafts are different from negotiable instruments like check. When a bank issues a demand draft, it is no longer the customer's credibility which is at stake. Unlike checks, demand drafts are issued by banks and therefore are paid and settled by banks on their own account. The bank is therefore providing a kind of guarantee to the party accepting the demand draft. For all practical purposes, a demand draft can be considered to be as good as cash because it is not subject to realization from the customer's account. A demand draft will always be paid unless the bank issuing it has gone bankrupt. Therefore, banks charge a fee to provide a demand draft. This phase also forms a part of their non interest income. Thank you.